Well, hello everyone, and welcome to another Pepperstone live event here on the internet. And of course, today we're talking about everything to do with scalping, mastering how we find the levels, and of course, more importantly, what's going on in the live markets so we can actually do some identification that way. As always, I'd like to say a big welcome to everyone that's joining us here today. We'll be going through volume profile use, price action, bit of supply and demand, and of course, also some indicators that we do use. And I thought we'd start here with the S&P 500 because as we know, we're coming up to a very important time as of this recording. The inflation data is set to come out in only a few hours. We've just seen the first US presidential debate or in terms of the new candidates. And of course, we're getting a little bit of volatility off that event itself. And this is set to spike and continue. So one of the things that we will see over the next few months, according to UBS, according to Fundstrat's Tom Lee, and many other professionals out there as well in the industry, is that we are going to see volatility increase. Now, if you know anything about the VIX, which is one of the major kind of market reads that you want to be using as a scalper, whenever the VIX is above 20, we're in what's called a potentially bearish leaning market, a market that's more volatile. It has a higher chance of course, bigger moves occurring. And when it's underneath 20 or underneath 15, more specifically, you're in more of a bull market, more of a stable market. So this presents us as for great opportunities over the next couple of months. And whether you're a scalper, day trader, or swing trader, there's going to be a lot of opportunity. So keep an eye on the VIX. We do know that it spikes into usually October. And what we saw in August, which was that high level, and we'll talk about the US dollar yen in tonight's show as well, that's the type of thing that we want to be paying attention to because it creates opportunity for us. So let's go back over to the US 500 and take a look at what we have right now from a scalper's mindset and, of course, more of a day trader and what we're looking at into this inflation numbers. How do we set up a chart leading into this type of thing? I also want to give a shout out to everyone that's joining us today. Thank you very much for being here. And remember to ask questions throughout. I will be answering them along with anybody in the chat. All right, so first up, we'll start with a bit of a clean screen. I'll leave a couple of chart levels here just because I like to have them on. But as many of you will know, we often use three particular moving averages. We tend to use the 20 exponential moving average. We tend to use the 50 exponential moving average. And of course, the 200 simple moving average. These are some of our favorites. Some other ones that are used heavily in the industry, the 5, the 8, and the 100. These tends to be the main moving averages that people use. So if you're not using any of these, if you haven't tested them before, definitely worthwhile putting them on. Now, how do you use a moving average? Well, a lot of people think of it as you're above the price action, therefore you're going to be, looking towards longs or anything like that. I found over the years the best use of moving averages is generally as what we call dynamic, support, or resistance. Now, why would we use them that way? Well, because what happens is a market will start a trend, whether that up or down. And often in that trend, it creates a pattern. It's what we call the 1-2 system. And what the 1-2 system is it's a very simple thought process, which is basically when you start a trend, if you start to see that particular moving average act as a support one time, so one time over here, and then two times, then often it will act as support for the third time. And that's exactly what we've seen here this week. Now, we are on a very high time frame. We're starting on a weekly here. But what I'm just kind of getting through is the idea of processing this. The 1, 2, and I call it 3, 4, 5, 6, 7 system. So the 1-2 moving average, whether that's a 20 on the 2 hour, whether that's a 100 on the 4 hour, or whatever it might be, it can act as incredible dynamic and support and resistance. Now, will it be the only indicator that we use? It never is, okay? You should always build a confluence story of separate indicators when you're starting to talk about charts. And this becomes really, really important when you're looking at things because, of course, separate indicators basically need to tell you different information. When I first started in trading back a long time ago, especially with indicators 2007, when I was doing it that time, what I'd do is I'd put on a lot of indicators. Of course, you had your stochastic, your RSI, MACD, moving averages in general, and then I would start to add on Bollingers and all of these sorts of things. And what ended up happening is I had one of those charts that you can't make sense of. I'd put 5 at least indicators that were oscillators on, and I wouldn't be able to make sense of the charts. And what often was happening as well is certain indicators, such as stochastic, RSI, and other things, were sometimes giving me all the same signal. And I thought, oh wow, I've got three of these things. That must mean it's strong or weak. Well, you've got to use indicators in particular that are separate, okay, that actually telling you totally different things and aren't just agreeing with the story for the sake of it. So let's take a look at this 20 moving average here on the weekly. It's well known to be pretty much one of the top Wall Street reads, which is the weekly 20 moving average. And it's called what we call mean reversion. And if you ever want to go through and have a look, you'll notice that in history, the 20 weekly in particular is very well respected from both the support side, dynamic support, or dynamic resistance. And this is where we found ourselves as of this Monday, right around this point. And it brings up, I guess, why I wanted to start here, because what we can now do is we can kind of break down charts in such a way as saying, okay, well, a higher time frame such as the weekly was finding a point of interest. And the reason we do that on the weekly and the daily and the 4 hour and the 2 hour, even if we're scalping, is because once we have that interesting point, we can then kind of dial it in. So let's just quickly reset this for a moment. What I'm going to do is I'm just going to put a highlighted line. It's going to be a yellow line here. And I'm going to call it something because I like to call it so I know what it is. And I'm going to call it the weekly 20 moving average. All right. And why we do this is because now we can remember it when we're starting to break down these charts. We can go to the daily, we can do some fibs, we can do all sorts of things. Another thing I would usually drop on the screen here if I was thinking of doing a scalp on this particular pair is I'd probably put some kind of anchored VWAP off the lows to see whether an anchored VWAP was also lining up with the zone. So if I wanted to keep that there, I could. And as you'll notice, because it's an anchored VWAP, it will remain on the charts. It won't adjust. So that's good. So we can actually leave that screen there. So we're starting to kind of build a case here. We've got the weekly 20 moving average, and we've got what we call an anchored VWAP off the low point. Now, with that, with our knowledge of possibly round numbers such as 5,400, we can start to kind of go, maybe I could be starting to see the sellers disappear and possibly buyers come back in. And this is where we can now look at the 2 hour chart and we can say, okay, well, what happened? It fell off really steadily. It was going down in a series of lower lows and lower highs. And then all of a sudden it changed trend on a small time frame. Notice here. Now, I ask everyone, even if you're watching this in replay or whatever on the YouTube or anything else, what type of candles are these? Someone in the chat put these types of candles in. What are these two candles? And once you think about it, we're going to explain why these two candles tell us a lot about this market condition. Michelle says, good morning while we wait for that answer. Absolutely. Great morning, Michelle. And must be obviously from overseas. And it is at this point that we need to be focused in on when it comes to price action. So we know that it's probably oversold. It's coming into a key level. Got an anchored VWAP, got a weekly 20 moving average. What else could help us as scalpers? Well, to recognize doji candles, and someone says this correctly in the chat, is to recognize a market which has gone to a high. There's the high. It's opened. It's gone to a low. And it's closed around the same point. Effectively, this means that the market was at indecision. And you've got to think a little bit differently about markets nowadays. You can't just say, oh, we're on a 2 hour or 4 hour or 3 hour chart. Remember, these markets are being traded by algorithms. They're being traded by robots and automation a lot of the time, especially in currencies and indices, does go through. And a lot of you are probably starting to build your own automated machines. So when you think about it, you've got a high, a low, an open, and a close. The market has been to the high, the market's been to the low, but ultimately it closed around the same price as the open. Therefore, it's indecision. And why this is so profound is because when you think about all the time frames underneath this 2 hour, what does the chart probably start to look like? Well, it probably starts to look like this, effectively a coiling market or a range-bound market, or some people would call it a channel in terms of patterns. This means that this is a point where the market's pretty happy. And then something's happened. The market's gone down and it's closed to a new low. And that's fine. The bears were in control. But once it takes this high, once it goes past this level up here and this high, something profoundly different is occurring in this market. So this is where you start to, as a scalper and a day trader, is you start to build a really good case for the market. You start to say, okay, well, has the trend changed around here? And is this a key point? We often say in trading, it's patience, react, don't predict. Now, why are we doing it this way? Well, when it comes to patience, react, don't predict, what we're really looking for here is we're looking for the signs, some form of statistical edge that we can play with. And I will tell you, to get statistical edge in trading and investing, I've actually read a lot of psychological books on this. In fact, I've looked at a lot of things that aren't even to do with trading and just to do with just human psychology. And it's pretty much proven around 40 reps is the perfect number to know how your system's working. So what does 40 reps do? It gives you a good chance to understand your statistical edge. How many wins did you get taking the same types of trades? How many losses did you get? And how many break-evens did you get? Also, should you be considering winning and losing? About coin flip of the time. Are you winning 65% or 70% of the time and losing 30, 35%? That helps you understand statistical loss ratios as well, because at some point you're going to go into one of those consistent losses. We've all been there. Yeah, I've been there as well. I know what it's like. You lose a few in a time, maybe you lose 5 or 6 trades in a row and you say, oh, my system's broken, it doesn't work. Well, you must have those recorded 40 reps. Regardless of that, what's happened here is you can see the market on this 5-minute time frame is a range-bound market. Effectively, this is a range-bound market or a coiling market. It's broken to the downside. And of course, at this point, shorters are in control. Something then happens, though, on the Monday. It gaps above, and it continues to move forward through the futures into the market. And the reason you know it's the futures is the time down the bottom, but also the volume. Now, when this is occurring and it breaks through this high here, what's it doing? It's getting past the point of indecision, which were those dojis on the 2-hour. So effectively, this is now at a point where the markets have decided, okay, well, I'm bullish now. And maybe as a scalper and a day trader, you might also want to be considering bullish. Why? Weekly 20 moving average, anchored VWAP, psychological level, change of trend, oversold style market on many different indicators, whether you're putting on something like a Bollinger or any other real extreme indicator, you're going to find it's there. You're building that storyline. So, of course, the market then continues to go up, and entry is only part of the discussion. When you enter, what else do you need to know? I want to know where my stop loss is and where my take profit's going to be. So in this case, where would my entry be? Let's say I entered here. Where would my stop loss be? Let's say underneath here. And where would my take profit be? Well, that's the next question. So when we're looking at a chart like this on a 5-minute, we also need to be well aware of what has come before us. Look at all of this structure. So many key levels, so many things going on. What should we be pretty interested in? Well, I would argue, where are Wall Street's largest positions in this? Shouldn't we need to know that? And of course, with Pepperstone connected to the TradingView platform, we can do this. By loading up a fixed range volume, we can actually pull it through this area. And what you might recognize is around this area up here, 55.12, seems to be the most traded zone. And we have what we call the volume profile kind of low end, and we've got the volume profile high end, and we've got the point of control. So in this case, we know that somewhere probably in here is the danger zone for this long. That's where the first scalping shorts could come in. So say we enter the buy here, we place the stop loss here, and we consider that this might be our entry, our kind of exit point, about 5,500. Good psychological level too. Then we've got to say, okay, well, if we're winning this, let's say 55 to 60% of the time, because we know our odds and we know our reps, then we need to say, well, is it going to be making us money? And this is where one of the other tools that we use on the TradingView platform can be so helpful. And what we can do is we can actually load up a long position tool here. And you'll notice that we have a stop loss, which is underneath this low. We have our entry point around here. We can actually set our take profit to 5,500. And what that ends up giving us is a 1.56 to 1 ratio. And that's better than most pattern traders get in the markets. Are we using wild things here. No, all we've done is we've used a high, well-known moving average. We've looked at the 1-2 system, being the weekly 20 in this case. We've then brought in an anchored VWAP, and we've recognized a psychological point in the markets. Then what we've done is we've said, okay, does it make sense for me to take the risk? Because not always is it going to make sense to take a trade. But in this case, we know where our stop loss would have to be, and we know where our take profit would have to be. And of course, as we scroll across, we can see how that has worked. And you'll notice right around that 5,500 is exactly where the market got to over the last 24 hours. So this particular level makes perfect sense for it to get to. And now we're ahead of the most important news being CPI. So I'm spending a bit of time on this chart because we will go through some others live in a moment. But this is the type of way that you might want to start thinking about markets and adding into your systems, using the volume profile tool we talk about, using higher timeframes to figure out these levels. And of course, now that we're armed with that knowledge of where the most traded zones are, we can now say, well, this area here could be of interest for us to see how the market reacts post CPI. So if the CPI result comes out, the market comes up into this zone, and then it gives us a pretty much a sell signal on our system. Well, that could be fairly strong. It's kind of what happened here during non-farms. The non-farms came in, it ran up to this area, and then it sold from that zone. If we go up in here again, we structure around, we go underneath this zone, that could be a sign of weakness that you might see on a 5-minute chart. So again, it all starts on the higher time frames, and then we break it down. So leading into this CPI, we can also then go to a few other higher time frames. Let's go to a 1 hour. And you may notice when you go up to higher time frames, we'll do this here together, you may notice that we have this 5,500 point. We've got a high and we've got a high. And it looks like the market sold off these points fairly aggressively. That's interesting. Let's go up to higher time frames. Let's go to the 2 hour for a moment. Okay, we can see wicks. Let's now go to the daily. Okay, it looks like there were really significant wicks. So what that's kind of telling us now is we know where the bears could be. They're positioning around here. But if the CPI news comes out positively, and then we move against and we move above this 5,500 point, doesn't that open up significant change of trends? Well, it certainly could. And it could help us as scalpers and day traders to start to think about the smaller timeframes and look for the moving average potential 1-2 system as well in the direction of that trend. Do we have a 1 hour 20 moving average? Do we have something else that's following? Can we then apply a very similar setup to those particular small charts? So I hope you guys are kind of enjoying this because, of course, this is how I believe building position bases and understanding markets better works. Not thinking so much about the scalping time frame of a 2 or 3 minute chart, but instead thinking about it from a higher time frame, moving down through, understanding that probably all of the biggest transactions are going on in the higher time frame. And then when we break it into these smaller time frames, what we're really doing then is we're scalping and finding pinpoint entries. And this is really, I believe, the next understanding. We all do the same thing when we come in. We start usually on a bit of a daily and maybe a weekly, and you might do some stocks and you might do a little bit of commodities action. And then you'll always go into the same thing. You'll always go into the smaller timeframes and say, I'm going to be a scalper, I'm going to be a day trader. And you won't usually look at a time frame above an hour. I believe that is one of the greatest mistakes that we all make as retail traders. And you hear a lot of scalpers saying, I don't look at anything above 2 hours. What's the point? Well, the point is that's where all the biggest traders are. If you talk to someone that works on a dealing hedge book, or they work on Wall Street, or they place large funds, specifically something like superannuation in Australia or 401k in the US, they will be making decisions on close candles, and they will be making decisions on opens and making big single leg trades. Now, those particular ones can have massive ramifications to the market. And we also notice another thing here as well, the 20 moving average, which is this red line. If we closed above 5,500, what that would also be showing us is that the market would be going above a pretty important moving average, which often again acts as dynamic support resistance. And if you don't believe me, have a look at the 20, check it out on many of the runs here on the daily as well. You can see the 1-2 system particularly working out here. I'm just going to show you that replication just so you can see it. So here is the market goes up, kind of comes down to 20, makes a new high. I know nothing at this point based on this system anyway. Then it comes down and hits it again. Then it makes a slight higher high. Then it comes down, tests again. This could be a good buy. 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 This. And then, of course, it makes a lower high, breaches, no longer valid. All right. But you can see how long it stayed long for. That helps us as day traders and scalpers because it shows us that our sentiment should probably be more towards the buy end. So let's now jump into a few other charts. Of course, with the US 500, we know CPI is going to be one of the, Stuart says here, good buy or good buy? Yeah, I get you. No, good purchase, Stuart. So if we do get above 5,550, that could be a very strong sign from a technical standpoint based on what we've done some analysis here on. But of course, now we're still in the danger zone because we know where the biggest trades have been. So I think, from a person that's down here and they're long on a day trade, maybe this is where they want to descale their position. They want to break even their position. Just start to think about it this way. And it's pretty life-changing, I think, in terms of the market itself. Yeah, don't worry, Stuart, I get you. All right, let's move over here to some other charts. Let's have a look at gold. And in many ways, it presents a very similar style situation. We're on the daily here. You can see the daily 20 moving average. You can see that the market has also started to do some consolidation. Now, I ask everyone here again, pause the video if you're watching this on replay and put in the comments, and this is where we go full circle. If we were to go up to a higher time frame, let's say a 3-week chart or a monthly chart, what could this price action look like potentially on one of those higher time frames? Can you think of the type of candle that it might be forming? I know to me, this really started to make me break down these timeframes totally differently. And even if I was scalping a 1 minute or 3 minute chart, I get asked this all the time. Do you love the 1 minute, the 3 minute, the 2 minute, the 5 minute? I always answer the same way. I love market structure. Stuart says here on a higher time frame, you could see it as a doji chart. That's right. And you'll actually be able to, now I haven't prepped this particular portion of today's talk, but let's have a look on the monthly. Now, the monthly is not big enough because, of course, it hasn't been sitting there for a while. Let's have a look at the weekly and see what the weekly looks like. Well, look at this. Doji, that's a doji, that's a doji, that's a doji. So what this is telling you is that the market is undecided. Now, we know that because of the smaller timeframes, and you might be saying, yeah, well, duh, man. But what it's doing is it's coiling. And basically, this is what we call a pullback in time. Effectively, it is burning time and is going sideways. And this is, of course, resetting indicators. So if you recognize that a market's in a pullback in time or potentially in a range-bound market by seeing that higher time frame doji, what that could tell you is you might want to start your range-bound system on the scalping side. You might want to start marking out the low, marking out the high, and trading within those boundaries until you're proven otherwise for a break to the upside or a break to the downside. And this can be very helpful as well, because remember, one of the problems that many people have for scalping and day trading in general is recognizing trend. So I think anyone could tell you gold is in an upward trend. But when it becomes range bound, it can be like watching paint dry if you're not recognizing that it's actually range bound. And what would be the first sign of figuring out it's range bound? Looking for the doji. Once you see the doji on the weekly, then the smaller time frames you can start to play with. And you can then go to something like a 2 hour, and you can say, all right, well, let's start bringing out the oscillators, things like stochastic and other things. So for now, where are we? Well, no surprises. Ahead of a big piece of news, we're at the high. Why would we be at the high before the CPI? And the reason I'm not making too many predictions in this particular video right now, or actually looking at it from, oh, yes, this looks like it's super long or anything, is because CPI is one of those big news events. When you get a big news event like this, you really have to be structuring the market and understanding that, okay, here we've got upward trend. As a scalper or a day trader, you're probably not really wanting to enter into a short here. Why? Because the news could push it through. And that's what happens. Markets will go towards a critical resistance or a critical support right before usually key news, and then they'll break it potentially when that key news comes out. So you'll see here with gold, we've got the resistances across the high, we've got the supports across the bottom, we're at the res, and it might be tempting to short it. And maybe that's what statistically has been happening. You can see here rejection week, kind of looks short on the small scalpy timeframes, just based on price action. The problem is with CPI, it could easily break through. And when you consider the higher timeframes, because it's been coiling, the trend is up on the higher timeframes, it could easily squeeze you. Now, I ask everyone out there, and let's be honest, because I know a lot of you guys will have had this. Have you ever been squeezed by one of these events where you've entered in before the news, it's shown you what you think is a great setup towards the short, and then all of a sudden it goes off in that direction and continues to squeeze you and continues to go back, like your trade just goes absolutely out of control, and all of a sudden you might have blown your small account, or even worse, blown something big, or of course just gotten stop lossed. It seems like a few of you have it happen to you. Michelle, Stuart knows, you know the answer to that question. Annoyingly, yes. Yeah, it's happened to all of us, yeah. And this is just something that kind of goes on because we want to be in our structural setup and we want to always predict. But sometimes it's better to say, well, you know what? I recognize this is a pattern. I recognize we've been stuck for a while. I know the market's putting pressure up here. I'm willing to maybe not take this trade here and instead look for the potential of a trade afterwards. Now, what would happen here? What if the market went bullish and then pulled back into this zone? Well, that could open up a very good day trade for us. Let's have a look at a way we could apply this. Let's say we go through the structure. Oh, wow, there's a lot of trade happening right here at about 25.15. So if the market then breaks up and then comes down, again, pulling back, and then finds a buyer here on a scalping time frame, that could be a good little area for us to find a scalp towards the upside. So I think these are just some of the ways that I would apply it to the markets. So with gold, of course, it's coiled. We did this last week when we talked about silver. We talked about the most traded zone down here. We talked about the rejection that happened here. It obviously got up to the first level of resistance, sold back off, but you'll see this higher time frame level prevailing. And that's really important. We also talked last week about oil when we were doing this video and this series that we do. And by the way, subscribe and make sure you're a part of this Pepperstone stuff in the links and in the description down below, because we are continuing to do this learning experience throughout the next coming weeks. And we really would love to have you here. We appreciate your time. And more importantly, I think this is a very important fundamental understanding to TA, to price action, all these types of things. So US oil obviously dropping down, hitting into one of these key levels, absolutely getting destroyed. And you'll notice that it's going from a series of lower lows to lower highs to lower lows to lower highs, all the way down. And this is, pretty key, because when we're in this level and we're making a series of lower lows and lower highs, we now can say, well, did we see any particular moving average? Did we see any, and you'll notice I'm linking back to this because it's important, area where it was rejecting off. Now, I would argue the 2-hour 20 is not too bad. You can see here resistance, resistance. So let's say we'd done that as a trade. Down, up, 1, broke to new low. Down, up, 2. Okay, that's the 1 and the 2. Makes a new low, pulls back a little bit further past it, but remember your stop loss should be here. So you're still smiley face. Okay, we sell. All right, maybe we sell again. So this is 3, this is 4. We come back up to it. Okay, we find it again. Then we sell off. Okay, so we're still smiley face. And now we find ourselves back at this point. Now, to me, actually, I think this might not be a sell anymore. But statistically, this is the type of area you would probably still try to continue on with it, because, of course, the trend is still down. And you can see here you've got your 1, your 2, your 3, your 4, and your 5. You probably won't get this trade. You probably won't get this trade using this system. But you could have got this. You could have got this. You could have got this. Beautiful, because it's following that repetition. You might say, well, is this that easy? Well, it's not that easy. Of course, you want to build other systems into it. But I do know, because we've done higher time frame, notice I've written watch reaction here. And this is the whole point of today's video. To scalp effectively, you must be aware of your surroundings. By not checking the higher time frames, you're effectively being blind to what is going on in the most important money flows in the world. And if you don't know about this level, And you can see it on a weekly, believe me, check it out after this recording and after this video. If you don't know about this level, then you won't be able to recognize potentially this being one of those key points that maybe you want to stay out of the replication. So maybe you took number 3, number 4, number 5, but you may not take number 6 because guess what? It's at a key level. And instead, what you might be starting to say is, well, if it turns, then I might want to start potentially trading towards the upside. Even though the trend is currently down, we want to see a trend change. We want to see things like the 2-hour getting taken out, and particularly this 69 level that I've got written here. And all of this becomes really important. So this all happens before CPI news. And that's why we're here. That's why we're in this structure and why we're finding so many of these key levels happening all at the same time. It's no different on the US dollar. If we move over to the dollar index, you'll notice, where is it? Well, let's take a look together right now. The daily 20 moving average. And again, you'll see here a 1, down, 2, down, didn't make a new lower low, almost got to a new lower low, but didn't quite do it. So this is going to be very questionable. But at the moment, you'd have to be thinking it's still more short than long. It could certainly go long, though, because it didn't make a new lower low, and it's before CPI. So it's before this major news. But yeah, it's at that key level. So yeah, good stuff there on the dollar, good stuff there on everything. Now, there's one other currency I wanted to bring up today because I think it's really interesting. The US dollar yen. Now, if anyone has been watching the US dollar yen, I've got 2 arrows here. You may be aware that we're back to where we were in the carry trade when the market went haywire just a month ago. So the US dollar yen broke down to 141.69. It hit this level, and what happened? The VIX, which we mentioned earlier today, went to 65. That's high. That's very high. I've only ever seen that like twice in my, well, 3 times ever in my trading career. 08, GFC, 2020, and just a month ago. A historically high VIX, an extremely high VIX. The market freaked out in many ways. And at the same point, we actually saw 51.10 from the SPY. Now, fast forward it to a month later, we're at the same point on one of the supposed issues, yet we're at 54, whatever it is, 80 on the SPY. And of course, we're certainly not at a VIX 65. We're at a VIX like 19 and a bit. So it just shows you that what the market actually freaks out about is the speed of something. So when something happens and it happens quickly, it's the fear of the unknown that makes these markets wild. We're back at the same level, yet it's not freaking out as much. But it's certainly something to watch because, of course, now that we're back at this critical zone, notice the critical zone on the higher time frame, daily here, there could be a very strong reaction of this. And this is a day trader or as a scalper is something that you will be starting to want to look at. Now, I don't really think the US dollar yen is the best trade in the world because at the moment there's a lot of central bank interference into it. But you will notice it's at this key level. And of course, how it reacts over the next kind of few hours could present a potential trade. And that's what you're really wanting to set alerts for. You're really wanting to recognize, okay, well, I want to recognize that 144 is clearly a key zone. I know we're in a current sell-off. Do I have any replication on the smaller time frames? Do I have any big news? In this case, the CPI and the PPI over the next 48 hours. Well, maybe I don't want to trade this pair just yet because it's too risky for me, but I can revisit it in 2 days' time. Perfect. If that's your decision, that's the best thing to do. Make sure you do this, though. It does make a difference. Michael says here, this is great sharing. If I can review it, that would be great again. Well, yeah, you should be able to review it because, of course, you have signed up. So make sure to sign up for it. Anyone else that wants to see it. And, of course, I believe you'll be able to view it as well with Pepperstone. So that'll be awesome. And hopefully you get some value from it because that's the whole point of this stuff. So anyway, the yen is at an interesting point. Again, it sounds really scary. VIX 65, 51.10. Sure, you can frame it that way, but really I think the reality is here for scalpers and day traders and everybody is that it's no longer the fear of the unknown, it's the reality. And the market doesn't mind to see it at this point. So yeah, that's where it's at. Now, as we always do on this show, I always like to hand it off to a few questions. So if you do have a question that you want to ask about any specific pair or maybe a question about an indicator or something, I'm more than happy to answer that now. What I will do is I kind of break down another pair live in the market right now while we're waiting for a few questions to come through. But yeah, we covered gold, we covered oil, we obviously covered the dollar. You can see why all of these are at critical points, ready to break out, ready to make a big decision, and how that can be really good for scalpers as well to come in after these events. Not predict it, because predicting it's just coin flipping. It's a bit of a gamble. It's not really worth it. But instead to react afterwards. And you might think, well, reaction means I'm slow. Sometimes the trade will go off without you and run away. But you've got to come from scalpers, don't make money from taking tons of trades. They make money from taking well-calculated trades at points where they have edge. You must have your edge. And if you're gambling, it's a waste of your time. So always remember the 40 reps, the replication, and getting into this kind of mindset. It can really help you. All right, I guess what I'll do is I'll have a quick look here at the Russell 2000 IWM. And the reason I'm looking at Russell 2000 is just because I wanted to show the key here, which is the fixed range volume profile on the upward tick. And you'll notice that it's heavily traded around this 2080, 2075 zone. It's moved a little bit up over the last 24 hours because, of course, more trades gone through here. What's that telling you? Well, the market has sold off into a key zone. Would this area, and I ask this to everyone again, pause the video and let us know so you can answer these questions, would this zone really be where you want to continue to short? Well, maybe not as a scalper, because we know on the higher time frame it's a critical level. And I think that's always important to note when it comes to this stuff. So make sure when you're looking at this that you're focused in on those key levels. So we know we're at a critical point, again, right ahead of CPI, which is pretty normal. Stuart says, I don't have a question, but I just want to thank you. I've learned a lot from the question. From you guys at FXC and the day trading course that you have. Thanks, man. Awesome. And look, you constantly keep learning, keep slightly modifying the system, and just keep up with it. Even over the last couple of years, as we built, a really big following. And of course, I've met new people in the industry and met some amazing minds that have shared some of their information. Now I'm hopefully imparting that onto some of you guys. What I realize is that you must be kind of self-adaptive. The markets are always evolving. You don't have to necessarily change your core. In fact, my core investment strategy, the core trade strategy that I use is the exact same. The difference is I slightly edge off certain tools. So I think a good rule of thumb is that if you have about 7 tools, let's say 7 indicators and 7 separated tools, if you want, our minds can't handle about that number. There's about too many after that. So what you might want to do is if you're going to include a new one, you're going to have to remove one of the tools that isn't working for you as well anymore. And what that will be is it's kind of like a exchange traded fund of an index. It's kind of self-adapting. Remember, when you think about businesses, the businesses that were big 30 years ago or 40 years ago are unlikely still to be the big businesses. Maybe 1 or 2 of them are, but I would argue that every 30, 40 years, you have big regime changes in businesses because things change. It's the same thing in markets, slight adaptation. Hi, Tom. What are your thoughts on the Euro USD given the forecast rate cut? Oh, yeah, we've got a question. Let's go to here. Forecast rate cut tomorrow at 0.6% from 4.25 to 3.6. So again, this is where narrative versus scalping mindset will come in. A narrative might be that the logical conclusion is whenever you think about that, if they do a 0.6 cut, let's say even most people are going to say, well, that should mean that the euro is going to weaken, okay? Because the euro should weaken as it becomes less desirable to hold around the world as the interest rate is, of course, getting cut down. However, what's happened recently in price action? The euro has already been falling now for quite a few days. So it may continue to drop, and the price action's obviously still on the negative side. And you can see this here because we're not quite at these significant lows such as the 10969 area. We have made a new low here, and we are generally in a bearish thing. But I wouldn't necessarily fall into the trap of the news as in the narrative, and instead I'd be looking at the price action. If I was checking this out from a scalper's perspective, okay, we were up over here. We started to come down, making a series of lower lows. It seems like something happened around this point here. So that is around 101.55-ish. We had these kind of highs, and we're pressing that again right ahead of CPI. Of course, the current news could easily push this into 110.80. Then that's the next res. So as a scalper, because you're looking at the higher time frames, you're going to be recognizing that here, a break above here could expose 1180. 1180 could be where we're sitting before that euro cut expectation. And then you might think, well, it has to go down. Don't think it has to do anything. You don't know what's priced into this pair. So it's very important that in especially currency that has no fair value, really, it's just a floating kind of rate, that you leave your opinions at the door and instead you focus on the price action. If I was to say the higher time frames are negative at the moment, I would say the daily is down. Okay. However, that I can see a very good case for this as being a potential. And if I saw the right setup for that, let's say I got a post CPI kind of setup trade, would I take it as a scalper? Of course, I wouldn't really have a problem with that. And I wouldn't really be thinking too much about the implications of 0.6. But if you ask, what does that usually do? The normal, let's say, economics method of what 0.6 means is it should mean a weaker euro versus the US dollar. The reality is some of that will already be priced in, if not all of that might be priced in. And you can't tell how much is priced into that point. Michelle says, thanks, Tom. That's really good advice. Noted. Yeah, it's just a good learning experience from that. All right, guys. Well, I'm glad that you enjoyed the show. Quite a few people in the chats tonight, so it's fantastic. Obviously, I want to go through and do a little bit different. I know this is obviously a scalping session, so we talked a little bit about scalping going down to the smaller time frames. I think the thing here is what I'm trying to get through is the multi-time frame approach. I just see so many people failing at that and just skipping through like 2 minute, 3 minute, looking at order blocks, looking at SMC theories, looking at all this other stuff, and they lose sight of what really is going on. Large institutions are positioning all the time. Remember, they float a book that is always net a certain position long and short, and all they're doing is adjusting that book. And when you think about it that way, then you really can see that you're looking for points where the market is moving from what I call one equilibrium to the next equilibrium. When you can pinpoint those on higher time frames, you can scalp them on the smaller time frames and get a bias that is approaching a statistical edge. Find your edge, do better trades, don't overtrade, come from an abundance mindset. Have a great day, guys. Thank you so much for joining us here today in the session, and we'll see you next week, same time, same place. Links in the description down below so that you can, of course, subscribe and find out more from Pepperstone. Thank you very much, and say thanks to also Pepperstone for helping make this happen. Catch everybody.